If you're close to your first $100,000 in savings and investments, or you've already crossed it, congratulations, because that's one of the biggest milestones in personal finance. Will give you real confidence, and it should. But here's what almost nobody warns you about: this is also exactly the moment most people start quietly sabotaging themselves today. I'm walking you through 7 mistakes people make right after hitting 6 figures, and at least 2 of these you have probably never heard anywhere else. Let's get into it. I'm the host of Crestaro Capital, and if you're building toward this number right now, stick around till the end, because mistake number 5 is the one that trips up the most people. Mistake number 1 is coasting. The second people hit $100,000, a lot of them quietly ease off the gas. Let me show you exactly what that costs. Say you hit $100,000 in investments and decide, I'm just going to let this ride. From here, at an average 8% annual return over 30 years, that $100,000 alone grows to roughly $1 million. That's genuinely great. You'd retire a millionaire from that one number alone. But now compare that to actually continuing your habits. Say you keep investing $1,000 a month for those same 30 years. That path ends around to point for $1 million. Same starting point, same market. One decision. The gap between coasting and continuing is well over $1.3 million. And here's the part that stings the most: the decade right after your first $100,000 is the most valuable decade you'll ever invest in, because every dollar you put in now has the longest possible runway to compound. A dollar invested in year 1 of a 30-year stretch can grow to roughly $10 by the end. That exact same dollar invested in year 20 only grows to about $2. So $100,000 isn't a finish line, it's the starting gun. And here's something most people never calculate: if it took you 7 years to save your first $100,000, your second $100,000 at the same contribution rate and the same average returns usually only takes about 4 to 5 years, because compounding is now doing real work alongside you. The third $100,000 comes even faster, and the fourth faster still, which means the version of you that stops right here is walking away from the exact point where the math finally starts speeding up. Mistake number 2 is almost the opposite problem, and I call it playing hero. People hit $100,000 and suddenly feel like their success has earned them a promotion out of boring index funds and into concentrated stock, baits, options, leverage, whatever's trending that week. They see someone online bragging about 15% in a month, and suddenly 8% a year feels embarrassing. I'll be honest, I've felt that exact pull myself. But here's the flaw almost nobody catches: your first $100,000 is proof you're good at saving. It is not proof you're good at picking investments. If you saved $1,000 a month for around 7 years at average market returns, roughly 85% of that $100,000 came from your own contributions. The market itself only did about 15% of the work. On top of that, if you built that $100,000 during a strong bull market, every single decision you made got quietly validated, which tricks your brain into thinking you're a genius, that confidence is fragile, and the music always stops eventually. If you want to scratch that itch, cap speculative baits at 5 to 10% of your portfolio in a completely separate account. So if it goes to zero, your real progress survives untouched. And here's the trap that hides right next to this one. While people are chasing an extra 10% on risky baits, a lot of them are simultaneously earning almost nothing on the cash sitting in their regular savings account. The average savings account in this country pays a rate so low it barely registers. Meanwhile, a high-yield account can pay 9 or 10 times that same rate on the exact same $10,000. That's hundreds of extra dollars a year for doing absolutely nothing different except moving where your money physically sits. Mistake number 3 is optimizing the wrong lever. Once people hit $100,000, a lot of energy suddenly goes into micro-optimizing, chasing a slightly lower expense ratio, obsessing over tax loss harvesting, agonizing over account structuring. None of that is useless, but look at the actual math. Squeezing an extra 1% return out of a $100,000 portfolio is worth roughly $1,000 a year. Meanwhile, negotiating a raise, switching jobs, or picking up a higher-paying skill can easily be worth $10,000 to $20,000 a year, 10 to 20 times the impact for the same effort. And a raise compounds too, because it sticks around and grows every year after. There's a rough rule for when this flips. Once your portfolio reaches around 10 times your realistic annual raise potential, usually somewhere between $500,000 and $1 million, optimizing your portfolio starts mattering more than optimizing your income below that line. Your career is still your biggest lever. Mistake number 4 is that you quietly become a sales target, whether you notice it or not. Once you cross 6 figures, you become genuinely profitable for whole Life insurance salespeople, high-fee advisors, and exclusive alternative investment pitches below $20,000. Most of these people don't bother with you. Above $100,000, you're suddenly worth the effort. The pitch always sounds the same. You've outgrown index funds. You need something more sophisticated. Here's what that sophistication actually costs. A 1% advisory fee sounds tiny, about $1,000 a year on $100,000, but drop your return from 8% to 7% over 30 years, and your final balance falls from around $1 million to about $760,000. That's nearly $250,000 quietly handed to someone whose main job was putting you in the same funds you could have bought yourself. Whole life insurance is worse. Your first several years of premiums mostly fund your salesperson's commission, not your so-called cash value. To quick filters protect you here. If you can't explain the product into sentences, walk away, and always ask directly, are you a fiduciary at all times? Anything less than an immediate yes is a red flag. Mistake number 5 is the one almost nobody talks about, and it's the one hiding behind mistake number 1. There's a famous line in personal finance that the first $100,000 is the hardest, and after that everything gets dramatically easier. It's repeated on nearly every finance channel, including probably mine at some point. Here's the problem. That quote is exactly what causes people to coast. The truth is your second $100,000 is still mostly your own contributions, not compounding magic. There's a cleaner way to know when compounding actually starts carrying real weight. Calculate when 8% of your total portfolio exceeds what you contribute in a year. If you're investing $20,000 a year, your portfolio needs to hit roughly $250,000 before your returns alone outpace your own contributions. The more aggressively you save, the higher that number climbs. So the real milestone isn't $100,000, it's the day your portfolio starts out earning your paycheck. Mistake number 6 is purely psychological. Once your portfolio crosses $100,000, a normal 3% dip suddenly equals $3,000, a number your brain treats very differently than a percentage. That's when people panic, sell things they had no real reason to touch. Here's the thing that doesn't change. A 3% drop on $100 is $3. A 3% drop on $100,000 is $3,000. Mathematically identical, emotionally completely different, and historically the market's best days tend to land right next to its worst ones, often within days or weeks of a sharp drop. Miss a handful of those recovery days trying to protect yourself, and you can erase years of returns. My rule: never check your portfolio on a red day, and if you do, don't convert the percentage into a dollar number in your head. Let it stay abstract until it passes. And mistake number 7 is becoming the family bank. Once you're the first person in your circle to hit 6 figures, word gets around, whether you want it to or not. Suddenly you're the one getting asked for a car repair loan, startup capital for a cousin's idea, or someone's rent deposit. The expected return on lending to friends and family is almost always deeply negative, not financially, relationally. If someone asks you for $1,000, consider just giving $100 as an outright gift. No strings, no expectation of repayment. You help them, you avoid the awkwardness of chasing a debt, and you protect the relationship. If the ask is bigger than you're comfortable gifting, a clean, simple no works better than an emotional negotiation. I have a personal rule about loans, and I don't break it for anyone is easier to say and easier to hear than justifying it case by case. Now let's put all 7 side by side for a second, because the pattern underneath them is actually the same thing: wearing 7 different outfits. Every single one of these mistakes comes from treating $100,000 as an ending instead of a beginning. Coasting treats it as a finish line. Playing hero treats it as permission. Optimizing the wrong lever treats it as the only thing left to improve. Becoming a sales target happens because other people start treating your number as a finish line, even when you don't. The first 100K myth quietly convinces you the hard part is overreacting to red days happens because the number finally feels real enough to panic about, and becoming the family bank happens because everyone around you decided your finish line was reached before you did. The fix for literally all 7 of these is the exact same fix. Keep doing the boring thing that got you here in the first place: the automatic contribution, the low cost index fund, the emergency fund, sitting quietly in a separate account earning a real rate, the raise you asked for instead of the trade you gambled on. None of that changes just because the number in your account got bigger. If it worked to get you to $100,000, it will work even harder to get you to your second and third and fourth. So if you caught yourself in even one of these 7, you're not behind, you're just early enough to fix it before it costs you real money. And if this helped you see your next $100,000 a little differently, hit subscribe right here on Crestaro Capital and tell me in the comments which one of these 7 hit closest to home for you. I read every single one. See you In the next video,